Welcome. This is the Trading Pit, your home for sophisticated analysis of the crypto markets. It's bright and early on February 15th. Here in the studio is JJ and Ben Lilly of J Labs. As always, I'm your host, Marconi White. And we're going to start today with today's top story, which is, has retail returned? Robinhood reported earnings recently. The retail-centric investing platform reported crypto revenue of $43 million, according to Blockworks. While transaction-based revenue was up 8% year over year, monthly active users was down 4%. And this is really suggesting that the retail trade is mostly survivors of the bear market. And with Bitcoin trading above 52K and showing no signs of slowing down, JJ, I want to ask the question, how important is it for the retail market to return, for Bitcoin to reach these new heights after the halving?
I think historically what we'll see is retail is kind of the force that brings us above all-time highs. So typically they're not going to be too involved as we're trading below. But once, if we break above 69,000 again, we're trading at all-time highs. You can imagine the headline narratives that'll start spinning then, right? Like Bitcoin's up, 5x over the course of 18 months. And then you just start to see that FOMO come in. And that's how you kind of attract these retail traders that start firing it up again. And that's probably when we would see a push, like say 70,000 to the 90,000 plus region. That's really when you're going to see a lot of retail activity. Right now, I think the Bitcoin market overall is still kind of in this stealth phase. In a lot of people's minds, it's still never recovered from FTX, as crazy as it sounds. To us who follow it every day, it's not there yet in the general public's presence.
Yeah, I know the phenomenon's been tracked pretty well, that people like to buy high and sell low in this market, the opposite of what you want to do. And so, as you said, retail really comes back almost once we hit those all-time highs. I want to continue on with that. Antonio M. Juliano, founder of perpetual trading platform DYDX, notes on X, quote, "So far, our strong price action has not driven significant new users in crypto. Previous bull runs have seen price increase by an order of magnitude. We'll likely need to see that before the adoption really picks up, and that may take some time." Meanwhile, Philip Swift is suggesting that 50K is the line in the sand. And that's what he said on X. So, Ben, I want to ask you the question, do we need to hit an all-time high to see a return of retail? Is 50K enough, or is it something even higher? Are we waiting for 100K to start to see that activity?
Just to kind of echo JJ's sentiment, once we hit all-time highs, the fact that that just took place and the fact that we're kind of the worst is behind us and we're moving ahead, that's the narrative that the mainstream media will be disseminating out into everybody's news feeds. And everybody's going to kind of turn their attention back to Bitcoin and crypto and almost have this renewed interest, be willing to dabble in, kind of dip the toes in the water, accumulate a little bit of Bitcoin, see that P&L start to rise, dabble a little bit more. And that's really just the buying the top moment kind of mentality that takes place, and that behavior, which is you come in slowly and then you see that return and you're, oh, wow, imagine if I put 10x that amount into Bitcoin. Okay, now I'm really going to be, living large. And, on this chart right here, like this black line right here, this is the amount of unique addresses holding at least $10 worth of Bitcoin. And you can kind of see, if you look at it from a rate of change, which is kind of like the degree of which it slopes up, this black line, you can see it really starts to accelerate right when price begins to accelerate and approach those all-time highs and just start ripping. And right now we do see it's pretty good. And price was, of course, kind of responding, really that first catalyst for then everybody to start accumulating after the fact.
That's a good chart.
Yeah, it's really sad to see that we're going to have so many people that could have done much, much better if they'd hold on. To me, at this point, it's criminal not to have some allocation to a Bitcoin, Ethereum, at least the majors. Would you agree?
Yeah, definitely. Definitely would agree. I mean, just having some exposure, keep yourself interested in what's doing. I mean, I think about a month ago, we were talking about the worst case scenario for anybody that's been in this market for over 6 months now is leaving the market, because just the past week is a prime example of the feeling of FOMO that can just come over you, that you wish you did not miss out on this move. And so part of the reason why we have begun to really explore the options, offerings, and educational material is because users should not be feeling that FOMO. You can use options to hedge and not miss out on the upside while protecting essentially the downside movements that will take place at some point in the market and at some point in this bull run. And so this is just prime example of, this was a prime opportunity to use options for downside protection, but not miss FOMO to the upside. But yes, have some exposure, even for the coins you hate. Have a little bit of exposure because if they start ripping, you can go ahead and sell and feel like, you're holy, if you will.
Yeah, the coins that will not be named. All right. Well, we continue to see amazing price action in the market. We'll look at that. And when I bring this up, I'm trying to bring up some data. Now I've seemed to have lost it. But on the ETF side, total volume over the last 24 hours is 2.5 billion with a total market cap of 41 billion. And it looks like there's no end in sight to Bitcoin going up. However, we did see an announcement today. The court clears Genesis to liquidate 1.3 billion worth of grayscale GBTC shares. From the article on Cointelegraph, on February 14th, hearing for the United States District Court of the Southern District of New York, conducted via Zoom, of course. Judge Lane signed off an order to allow Genesis to sell off parts of its investments from Grayscale. Now, JJ, what does this mean from a volume perspective? We've talked a lot about liquidity events that could happen. We've talked about the point at which we may see a pullback. Is this going to give the market enough liquidity to start to maybe get a breather for the time being?
I think whenever that liquidity ultimately becomes unlocked and they start selling it, we'll see it, right? Like you'll see it, especially in the Coinbase volumes, which have just basically been nonstop buying for the past couple of weeks here. You just see these massive, like it's been never-ending swap in, right? And like we've been saying, these are price-insensitive buyers. So the people buying these ETFs in their 401ks, et cetera, they don't care. They're not looking at lines on a chart. They're just simply buying because they like the price today, and they're going to hold it for however long. A year, 2 years, 3 years. So there's that price insensitive buying that's going on. And I would assume that's still going to continue even as the Genesis supply becomes unlocked. So it's going to put a damper on like the up only effect, right? Like if we get up to above 55K, we'll probably see some selling and that'll continue as that supply becomes unlocked. But I think it's probably going to be absorbed mostly. Like I don't think it's any reason to. It's very well telegraphed. Like everybody knows that the supply has been on their books. It's going to become unlocked at a certain point and the market doesn't care. So I don't see any reason why it'll care all of a sudden in the future. It'll probably just provide a nice pullback opportunity ultimately.
Well, we've seen just amazing volumes for these ETFs. I think I was looking at some data this morning, showed 600 billion on one day, 400 billion on another. I mean, at that pace, any of this 1.3 billion that would be unlocked could be absorbed within a single week. Ben, I want to ask you, when do you think that the ETF volume starts to trail off? Do you have any perspective on that?
I'm not even going to speculate.
He doesn't have enough rum in his coffee to give us that information.
There you go. Yeah, I mean, this feels like it kind of caught the market a little bit by surprise in some sense, because the point that JJ made with the Coinbase premium relative to the USDT market on Binance and Bitcoin, that spread that exists, just once it's positive, that shows that there's a lot of buying pressure taking place on Coinbase. My chart here, this blue line, when it's above this horizontal gray line, that's a Coinbase premium. And you can see that once it starts to rip higher, price is following suit. And this is really that kind of ETF demand that's showing up into the market. I mean, you could see this blue line is actually a moving average. It's smoothing over that spread. But when you go ahead and you take that out, you can see how severe essentially that was, this move, right? $60 a Bitcoin in terms of spread, and price responded accordingly. So when does this flow subside? I'm just gonna let it happen as long as it's going to happen. And when we start to see it taper off, then we'll go ahead and say, hey, this is probably the time when it's going to taper off. There's no point in trying to front run it. Yeah. I mean, even Falcon X actually put out a nice report. I think it was called the Sheffield report. Sheffield was the one that was writing it. And one of the important stats I found within this report was that during this 3 to 4 p.m. New York time window. Tends to be when ETFs need to go ahead and really make sure that their vehicle has NAV. So they have to do these creations and redemptions of shares, which also accounts for volume on the spot market. This 3 to 4 p.m. window accounts for 10 to 13% of Bitcoin's daily volume. If you were to smooth over like how much that should be, it's about 4%. So you're seeing about 3 times the amount of volume just within that 1 hour window of what would be considered normal. So that's just kind of showing how outsized this ETF market is at the moment.
Yeah, it's totally investors running over speculators. Like everybody's looking at charts and trying to figure out, okay, is the top here, is the top here? And they just have these Giga Chad boomers that are like, don't care, buying and holding it forever.
It's
think
a one-way
of that
train.
behavior. Think of that mentality right there, right? They're not going to go out tomorrow on their spot holdings of an ETF share and go ahead and short it.
Mm-hmm.
No, they're just long only. Like this is the type of market participant that just lets price run wild until they finally have some exposure to the downside that they're willing to go ahead and do. Like this was in 2017, December 2017, like the futures market finally showed up at CME and they were finally able to really short this to the downside. And this behavior, this is going to be that first real opportunity, in my opinion, is going to be when the ETF options market opens up. And you'll see some people start to dabble, but that's the sign that Wall Street thinks there's really juicy volatility to go ahead and squeeze out of this market.
Mm-hmm. Yeah, they said that could come as soon as the next few months, but I expect whenever it does launch, we're going to see implied volatility have a sharp run up first because they want to sell that. That's going to happen.
I wonder how many burned fingers there's going to be, or hands, or entire bodies, when they're trying to short this momentum and it just never giving them the right trade.
We already see it now.
Exactly.
Mm-hmm. The timing of that options could actually, because you said about 2 months or 3 months, that's May, which I believe that's when the Ethereum ETF is kind of getting ready. Mm-hmm. You almost have your trade setup already kind of being telegraphed.
Yeah, well, it's it's going to be an interesting setup. All right, let's move into the actual charts. Do a little bit more of a market breakdown. Before we do, I want to say hello to Simon, Nicholas, JV, Adam, Elisa. Thank you for joining us this morning. Love to have you here. I see a couple of questions. One is the long call 23 February spread 70 at $5. Let's go. I think he's already calling out the fact there's some interesting volume, interesting options activity. We're going to get into that. And then I see a question here, I think from Adam, about the minimum for Dixie. We're definitely going to be covering that. If you haven't already, hit the like and subscribe button, hit the thumbs up button. Thanks, guys, for being here. Excited to go over this information. JJ, let's get into it. All right, when I look at the spot volume, obviously we were just talking about how bullish this is, but I'm looking at the RSI. It looks like we're a little bit overheated, but does it matter?
I mean, not until the market tells us it matters, right? So if we start seeing price breakdown back below 51,000 going towards 50,000, like maybe then you start to worry and take some chips off the table. But as long as it's humming along, like Ben was saying, you don't want to be standing in front of a freight train. And there's that whole dynamic of these price insensitive buyers. It just is what it is, right? Like they're happy to buy at this cost and they don't care about the things that we look at, lines on a chart. The overheated RSI doesn't matter to them. So until it does, and the market will let you know when it does, just keep going with the flow. That's basically the market update for today. It's just the market's moving. People are buying spot. There's some interesting dynamics going on in the options market we can get to.
Yeah, let's get into that in a moment. But I do want to look at the volume profile here. Is there any way we can get some signal of when we're starting to see some of this start to taper off? Right. I mean, we have some of the data that's being pulled by other analysts, and they're kind of aggregate that to look at the inflows. If I look at the chart that you were just sharing, JJ, it looks like maybe the volume is relatively steady. But is there anywhere that we're going to be able to see some of that before it actually happens?
I think you'll start seeing selling, specifically on Coinbase, right? So similar to what we saw after the ETF launch, like you see all of this red, which indicated selling, right? So you'll just see massive volumes of selling coming in. That's probably as good a sign as any that we're due for some mean reversion. But until you really start to see high volume sell candles, there's no reason to try and call a top here. As you see, it's just been this persistent swap. So I think the market will let us know when it's ready to turn around. It doesn't seem like it's today.
Not today, not today. What did we say? Be long until you're wrong, right?
Yep, exactly.
Okay. Well, let's dive into the options. I'm looking at some data from Deribit. It looks like the 24-hour volume is about 2.4 billion on Deribit. Interestingly, most of the options for the call options are sitting in the 50,000 range, but I do see one here that's 60,000 call. So unpack that for us. Are we starting to see another setup where we have a bunch of naked sellers? And no, this is all PG, that are going to have to cover at some point and just give us a massive squeeze to the upside.
I mean, there's a lot of people out there losing a lot of money on this move right now in the options market. That much is for sure. Like you look at below this, what we had written up yesterday, this is over $60,000 or 60,000 BTC value. So that's like 3 billion at current prices, just 50,000 and below that are in the money. So as prices going up, like these contracts have to settle. If we look at February 23rd, right, which is next Friday, we see there's over 3,600 of BTC at 50,000 alone that are currently in the money. So they're going to have to sell these contracts in cash. And whether or not they have the cash on hand, who knows? They might have to sell BTC, or they might have to buy BTC in the meantime if they want to keep these open as price continues. So it's going to be really interesting to see how it plays out now that price has kind of found acceptance above what was previous resistance. Like typically you'll see these massive amounts of call volumes and they don't get in the money. So this tells you that there was a lot of people selling calls that weren't prepared for this kind of high velocity move to the upside. Like nobody, after the grayscale unlock in January, the market just fell into the ultra low volatility environment. And everybody thought that supply would be too vast to overcome. So it seemed like a safe bet to sell volatility into the end of March. And now we really see some pain there from either naked sellers, cash and carry trade, who knows. But if we start to see price tick up strongly, you can bet that that's people hedging the sold options. And we've seen a good bit of that on Deribit back since price started breaking above 43K again. You just see how much buy volume there was on this USDC perp. And this indicates like a lot of hedging going on there because they sold those calls. So you have to get some upside exposure. And I think a lot of that can be contributed to how much open interest we saw on the True OI, which we pointed out a few times. It's basically gone up over $1 billion almost since January. So basically since the start of February, it's just gone up only. I think a lot of this is due to people hedging because they were caught off sides in their options positioning. Like you sold this 50K strike for say a couple $100 back in January when price was going nowhere. Now all of a sudden you're sitting on a couple $1,000 losses each. You do that 10, 20, 30, 100 times. It adds up to quite a substantial loss. So there's definitely a lot of cash and carry traders out there that are sweating due to all of these call options now being in the money. So if they start to sell spot and close out these calls, we'll probably see some mean reversion. If they're underexposed and they want to keep this call exposure open, they're going to have to buy spot on the market or continually bid perps, which is just going to send price up higher. And then it kind of creates this reflexivity effect where then all of a sudden now, what if this strikes in the money? Then you have the same dynamic playing out all the way potentially to above 60,000 as these call sellers get squeezed. So very interesting. Keep an eye on.
I want to unpack that. You just went through a very interesting market dynamic where everyone kind of has a way in which they expect the market to play out and the pacing of Bitcoin to rise up. Then we move into going down the risk curve and where the money will be allocated. I guess I'm looking at this now and thinking, how long is the Bitcoin only train going to run where everyone, as you just said, I mean, there's so much juice to squeeze out of this Bitcoin trade. A lot of people were doing that earlier this year. Now they're going to get caught off sides, but it feels like this is just going to keep on recycling as we see more inflows into BTC.
Yeah, it certainly could. It's just, I don't understand I didn't understand the logic of, if we look at the implied volatility levels, just how low they were back about a month ago or even 2 weeks ago, right? Like I couldn't wrap my head around why people would be selling out of the money calls when IV was this low, or out of the money anything. Like the ability for Bitcoin's price to move rapidly, we've seen time and time again. It seemed like people thought it would be more of a muted environment because of this ETF, but there wasn't really, outside of that grayscale unlock, like we absorbed that supply right away, and there didn't seem to be much catalyst for price to go nowhere. And inevitably you saw that bounce back, and now there's people in a lot of trouble with this positioning.
Ben, how much, I want to ask that, Ben, to you, how much is supply an issue for the market right now? I mean, everything is supply and demand dynamics here. We know that's the way this works. We see a lot of accounts, kind of insiders, if you will, VCs. I think I saw his tweet just today, and I'm drawing a blank on who it was from, but talking about the fact there is no supply. Even if we see the 1.3 billion being unlocked, you have most of the money being that holders, they're holding on for a long period. Now we have these other people that maybe if they have to cover options, how much is that supply an issue for the market that's just going to continue to push the price higher?
Yes, that's a great point. Supply shock. Those are the real deal in crypto, especially when it comes to Bitcoin. I'm going to go ahead and pull this HODL wave chart, which is probably a little weird looking, but Philip Swift, he's a very good on-chain analyst, kind of one of the earlier ones that invented a few good metrics that have become very popular within crypto. His site, Look Into Bitcoin, you can go ahead and get this HODL wave chart for free. You can see holders that hold Bitcoin for 1 to 3 years. So these are kind of these traders or investors that are willing to hold and sell with each cycle. And when price starts to rise higher, that's when you kind of see them going ahead and selling their Bitcoin. And you saw this in prior cycles as well, each and every time. And you're only starting to see it, right? And so what this means is if they're not really willing to go ahead and let go and profit on the Bitcoin that they do hold, like where's that Bitcoin coming from? And so this inelastic type of setup causes outsized price movements. And commodities are very known for this. And so when you look at crypto and most of these really supply growth rates for these tokens, if you have single digit supply growth rates for really any token, these sort of inelastic movements are common. And we see it right now with Bitcoin. You know, these outsized price movements to the upside take a lot of people by surprise, and they don't really account for the fact that, you know, this change in circulating supply happens slowly. You know, it's almost like this silent effect that happens in the background, and it builds momentum until finally, you know, a catalyst hits. And that's why the volatility chart that JJ was sharing earlier, right? When volatility was so suppressed and we were kind of saying, look, we're going to have a volatility regime shift. This has to happen at some point. And this supply dynamic causes these volatility regimes to happen with, you know, explosive movements. And, you know, when JJ was saying that, I'm thinking to myself, why are we so obsessed with trying to make Bitcoin a yield product? It has not ended well historically. And I know there's some structured yield products out there. Yeah, like this isn't going to end well for some of those. And I'm curious to see what those monthly reports look like in a couple months based on this move today.
It's picking up pennies in front of a steamroller. That's if you're going to look for a yield trade, don't do it in crypto. It's just there's just better ways to go about it. Like your risk reward when these things get slippery. Like a good example is in October, we had kind of that gamma squeeze above 30K because there was so much call selling above 30K. Then those people had to cover those positions. And here's a good example of like the supply dynamics that Ben was talking about. Price started to move above 30K, and all of a sudden, like you look at the order books, right? Like there was, say, price gets here, there's asks, right? So these, if you have to buy to cover, you could buy here because people are selling it. All of a sudden, these disappeared because they know a squeeze was happening. So that's what happens when you have elastic supply. Like you may think you could cover, say price goes to 53,000 and you're like, okay, I'll cover. Then all of a sudden those asks disappear from the order book and you have to continually buy higher. And it sends the price up because you're buying at higher levels. So the number of people see on their screens is higher because they're not looking at these supply demand dynamics. It just creates like this reflexivity effect where it's very easy to lose a whole lot of money very quickly if you're naked shorting.
Yeah, and let's take into consideration here, like with stocks, that tends to only be a dilution event when it comes to supply. You know, they go ahead and make new shares and they try to raise capital by selling those shares in the open market, or they'll try to do an auction of some sort. With crypto, that's a little bit different. You know, you don't have this supply effect in the same light you do with shares. And so that takes a lot of people off guard, that they're not accounting for how quickly this supply kind of evaporates underneath them. So
gets real slippery real quick.
Real slippery real quick. Yeah, it's amazing. It's astonishing, if you will, how poorly informed many of the analysts are. I think that come into the space and really just don't appreciate these dynamics. And I guess that's a benefit to all of us who have been willing to stick it in and to study the markets for as long as we have. So it's one of the reasons you should definitely show up on this show, like and subscribe, share this with as many people as possible so that you are in the know. And if you're interested in doing more and getting to know options better, JJ put out a video. Was it last week, JJ?
Yep.
Was it latest one? Oh man, it was a rock star video. Definitely go check that out. And if you actually want to start doing trading so you can get your paper trades done, do your small options trades so you can start taking in some of this action, use the reference in the description, which will be available for CoinCall. CoinCall is an amazing platform on which you can trade perps and spot and options. You can do all the trading you want with a beautiful interface and excellent fees. So go check that out. Start trading today, so you're able to start taking advantage of some of these trades and the knowledge that you have that the rest of the market doesn't. As we've seen, a lot of people are getting caught off sides. You don't want to be one of them. Okay, I want to move on to talk a little bit about perps before we get into the Dixie and rates, because there's a lot to cover there. We did have a question here from Adam S. Thanks, Adam. For the cash and carry trade, what level did you guys see selling out of the money options? I guess it's more on the option side. Just wonder what were the top two levels that you noticed? So JJ, going back to that question, maybe we'll just cover that from an options perspective, and then we'll go on to perps.
In terms of levels, like when were they selling these options? Like when did the selling begin?
Yeah, it says, what level did you guys see selling out of the money options? Just wonder where the top two levels that you noticed. So I'm not sure.
Throughout January, basically. So like into and after the ETF, there was just a whole lot of volume, especially in like the quarterlies. So if we look at March 29th expiration, there was a lot of 50K selling going on into the ETF because expectations were the price was going to remain muted, not make this large move up back above the January highs on ETF launch. So this seemed like a free trade. Like maybe it was trading at $2,000, $5,000 back in January, especially as price became compressed down below the 40,000 region. So it seemed like a free thing. Like you could just sell this, price isn't going to get back above the highs, and now it has. So they're finding themselves in a bit of a bind here as price and implied volatility is ripped.
Really, a lot of those trades, they came on a while ago, right?
Yeah, a lot. Very stale positioning.
Yeah.
I think there was a reluctance to cover this cash and carry trade as price kept going higher. Like people thought, okay, we'll get to 50K. Like that was kind of my expectation is we'll wick above 50K and it'll unwind, and it hasn't. So thankfully I wasn't selling options.
Smart man. You're selling videos instead. Okay, let's move on to perpetuals. The open interest, as I'm pulling up here, is sitting at about 14.5 billion, up about 1.4%. Interestingly, when I look at liquidations, we had about liquidations about 50 million in the last 24 hours. 32 million of that was really on the short side. So really shorts are getting squeezed here. So JJ, you've talked several times in this show about the fact that this is being used by people to really as more of a hedge, and less is more of a profit taking or a way to actually grow the account. When you look at those liquidations, knowing that you're seeing those shorts liquidated, is that just normal hedges going out of expiration? So that's kind of normal activity, or are you seeing people trying to jump in early as Bitcoin goes above 50K, trying to get some profit?
It's probably a mix. So if we look at the long short ratio, we see this is actually currently below 1 now, which is good sign. So you see open interest up, long short ratio down. That's a good sign that there's probably a lot of hedging going on, especially when we consider the spot buying that's been happening. And then obviously you have people willing to speculate, 100x that price is going to go down today, and then it doesn't, and they get liquidated. So it's a mixed bag. Like it's never just one thing or the other. There's always different baskets of people using these products, but I think overwhelmingly right now it's been cash and carry traders. So it'll be interesting to see as more and more shorts get liquidated. Do they start to sell that spot, or do they just eat the losses on the perps and continue to hold that spot unhedged? We'll see. Or do they keep at it? Maybe they just add a new hedge, right? We'll see. Yeah. But no signs of like extreme froth right now. I think we're probably getting there, especially if we get over 55K. Probably see some extreme funding rates and whatnot, but nothing too exaggerated as of now. That basis trade just keeps going higher. So it becomes more attractive. If we look at this, we could see basically the amount of yield you could capture doing the cash and carry trade across different contracts on different exchanges biannual basis. So still some juicy yields here if you want to hold spot and sell perps against it, if you can adequately protect against liquidations and you're okay with selling some if price gets above a certain level. And I think that's kind of the model for now. Just keep holding spot, selling these perps, capturing the yield and managing it if price gets too high.
Yeah, you mentioned a price gets above 55K. Just on our last show on Tuesday, for those there, they may recall, Benjamin talked about how there was a lot of FOMO coming from the APAC region of people that missed out on this trade. And he said, if we saw a weekly close above 50K, you may see a lot of buying, almost forced buying. So that could be even more fuel to this fire.
It's a powerful thing. It was like we were discussing before air. Like I would not to just FOMOing. It's even if it goes to 60K, like that's not the time to FOMO. Like over time, you get this 200-day retest. Doesn't matter the asset class. Price finds the 200-day. Right now, that's at 35K. There's nothing to say price can't go to 70 in the interim, and then maybe you buy the 200-day retest when this is back at 50. But your risk reward, if you waited a few months for it to retest 50 when the 200 days up there, it's still better, right? And you're not buying this top and then it reverses and you have to hold it down to 35K.
Oh, JJ offering the sophisticated trader viewpoint. Love it. Love it. All right, let's move on. We got time issues here. Let's move on to the Dixie that talk about the outside risk, the tail that really wags the dog. I'm looking at Dixie right now. It's sitting at 104.26. You know, we've talked about this several times about this 104. It was a line in the sand that we talked about last Tuesday, and maybe it was even the day of the session before, about how we shouldn't, maybe this isn't the time to totally be risk off, that the Dixie isn't going to quite swing at us right now. So what are we looking at the Dixie? How much risk are we seeing at an external perspective that could actually put a dent in this existing bull run?
So we had that large run up after CPI on Tuesday, which kind of, obviously we saw Bitcoin fall back to around 48,000. And then the day since, we've just seen kind of a cooling, like basically Fed officials, Secretary Yellen, I think Goolsbee from the Fed, they were just downplaying the inflation, saying it's not as bad as the data would have you believe. So believe them and not your lying eyes that inflation's actually going down, and the market seemed to like those comments, and it's moving along as if inflation won't be an issue in the future and they're going to cut rates again. So it seems like it's cooling for now. I still feel like this is a thing to be cautious of, and that's one of the reasons why I would say if you're long, stay long until the market tells you not to, but be aware of this. Like if Dixie run, I still think there's the possibility of Dixie blowing off. We know of these issues banks are having in terms of commercial real estate and whatnot. There's still a lot of risk embedded in this market. So be careful and don't give into FOMO. If we do get up to like 60K, don't take that as the sign that Bitcoin's leaving the station, never coming back. Inevitably it will. And the caveat there, unless you see like Dixie fall below 100 at the same time, in that case, it might be best to get out of dollars as soon as possible. But
yeah, you'll sell everything in your apartment and just go in.
Yeah.
No,
but
not investment advice. Do not listen to Marconi. Marconi does not know what he's saying.
If Dixie's strong and Bitcoin keeps running, I think that's probably a good short-term take profit signal. And in the interim, if we get above like 55 to 60K.
We got another question here from Adam S. How do you all see the momentum for Dixie and the consequences on BTC? You guys expecting the same price action as the past, or possibly new price action? I.e., as Dixie goes up, so does BTC. Please explain. I think you've covered that, but just want to put that out there, JJ.
Yeah, I mean, markets can remain irrational at times. I do think this price action is a bit irrational, but like we said, these are price insensitive buyers. So I'm not going to stand here and say, oh, well, Dixie's up, so Bitcoin has to go down. I'm not smarter than the market. So just do what the market's telling you. Right now it says it's bullish, and I think there's risks to be aware of underneath the hood, but they'll reveal themselves in time, and you'll see it in the price action before anything cataclysmic happens. So you'll have ample time to get out when things start to reverse. Right now it doesn't look like it's reversing anytime soon, so keep riding the wave, but be aware of those risks that linger.
Ben, I want to bring you up here. We oftentimes, when we talk Dixie, we want to talk rates. In fact, we've had some changes since I think you last joined us. It has to do with the number of buyers, the types of buyers that can start to do participate in auctions for treasuries. And we know that this year there is a lot of debt that is going to be issued. And I'm looking at the rates right now. They're basically about flat when I look at the 10, the 20, and the 30. So walk us through what you're seeing and what kind of I guess, dynamic that we may see as these new buyers come into the market as part of these auctions, and what that may actually mean from a Dixie perspective.
Yes, I will address the recent auctions, and don't let me forget, I do want to talk about the velocity of DXY and how there's been a muted response in markets in general. But I'll get to that, back to that after I address the Treasury auctions, which if we go ahead and pull up last week, I think last time I was on, we were saying there were some two big auctions with pretty sizable amount of debt being issued that's coming due. And if we go ahead and pull up those auction results on the 30-year bond in particular, the high yield was at 4.36%, which is pretty good in terms of a spread that exists between what they were, the range in which it was being sold. But more importantly, there's this bid to cover ratio down here that's 2.4. Now, what the heck is that? It just means the amount of dollars that showed up at auction relative to the amount of debt that was issued. So essentially 2.4 times the amount that was being sold. And historically speaking, is that a lot or a little? Well, let me just slowly talk while I pull the chart up to act like I was moving efficiently. Okay, so there we go. 2.5, 2.4. So these lines right here are the cover to bid ratio really last year for really durations between 2-year all the way up to the 30-year. So this teal little color is the 30-year. And you can see it's right around 2.4. So nothing drastic happened last week. If anything, the yield that exists already went up a little bit. That was really because that was a lot of issuance that was taking place. Okay, so really nothing happened out of the ordinary on those auctions. And you had DXY run higher. It was running hot. And nothing really seemed to buckle under that movement. And the Fed has been increasingly hawkish. And it's been noticeable in what the market thinks rates will be. This is September, for instance. This is what the market right now is pricing in, what the rates will be in September of this year. And these lines, what color is this? It's purple. Yeah, this is 4.25 to 4.5. So the market about a month ago was almost 50-50 chance that we're going to be cutting rates almost 100 basis points. That's steep, right? In terms of like rates barely getting a 25, 50 basis point cut, this was single digit probability. And just in the past, 3 days, look at how much that's shifted. Now there's single digit probability that we're going to be dropping to 75 to 100 basis points. And now kind of the bulk of the market thinks we're hardly moving. Okay, that's pretty significant, right? If the market was thinking we were going to get a lot more cuts this year, and now it's just changing its mentality that we're really going to do higher for longer, in part because of the recent print on inflation, and the dollar's moving stronger, and you're not seeing markets buckle yet, that kind of gives this cue to the Fed that it's okay to run a little bit hawkish in this current environment. They're kind of being given this green light.
So what is Ben, just kind of at a high level, when you say being hawkish, what does that mean? Does that just mean that the cuts will be minimal or not at all for this year?
It means it can be. So the way that it kind of really works is credit creation drives a lot of growth on an economy, and it can even drive growth on stock market prices. Credit creation, okay? So the amount that you borrow. And so as those rates start to rise, it becomes more expensive to borrow. And so if the rates are going to remain elevated for longer, these costs that are being incurred to borrowers are going to keep rising, which, increases the cost of capital. So that increase in cost of capital is going to translate to slower economic growth, kind of down the food chain. It's going to reduce essentially a lot of stock prices, because if that's taking place in the economy, then your earnings reports are going to be down a little bit. So hawkishness refers to these rates kind of being a little bit kind of this negative placeholder on the economy for longer. Dovish is the opposite.
Yeah.
Dovish is, we're going to loosen things up. We're going to let it run hot a little bit, but now they can't because they got this terrible inflation print that they're trying now to rationalize through the media at the moment. But it's not really working. But haven't seen the market really respond yet. So there's a little bit of like I didn't quite hear you. Can you say that again for me one more time? Taking place. And so when okay, let me repeat this. Inflation is bad. Like, then the market's going to respond. Right.
Well, okay. So I want to come in here and summarize a little bit because you unpacked a lot of really dense information there. What you have is you have a new set of dealers that are going to come in from a buying perspective into these auctions, treasury auctions, which in theory allows them to issue more debt at better, more competitive rates, which allows them to pay off debt at a lower rate, which is exactly what the treasury is looking for and what the U.S. government wants. The Fed can still run hawkish for a period, as you said, because we've got inflation, which is coming down from the economic level, not from the person on the ground level. And we're not really seeing the system buckle yet, which allows them to stay hawkish for a period of time, keep the constraints or restraints on the economy. Is that a fair assessment?
Yep. There's no reason for them to move. They can just be rigid at the moment and keep going.
And we're going to get to all those listeners who are still here. Thank you for being here. We're going to get to talk about an in-game as we start to wrap up the show, which I think was going to have to do with everything that Ben's just talking about, kind of at a high level, bringing it back into what that might mean from a Q2, Q3 perspective, from a liquidity perspective, because we've talked about several times, is there going to be a liquidity crunch? Ben, I think what you're talking about says we could get there. Is that right? Yes or no?
I think we're getting close. I think we're getting close. A couple of shows ago, I said these things move at like a glacial pace. It takes a lot of time, a lot of different moving parts for it to really, those headwinds to materialize. Those headwinds have been starting to show up, and they're getting stronger as far as this macro economy is concerned. And you saw recently the Fed went ahead and addressed, I believe, hedge funds and becoming dealers in the treasury market. And that was really addressing the fact they've been very active in this market for the past year. And so they just want greater reporting requirements put on those funds so they can go ahead and kind of keep better track of them and make sure they remain solvent and they have enough capital requirements as they go ahead and are active in that market. But what that also does is it kind of tees them up that if there is this liquidity issue that shows up that we've been alluding to for a while, that's kind of on our radar. If this liquidity issue shows up in the treasury market, this collateralization ratio that's going to exist is going to really kind of touch the books of a lot more entities now. And so that's going to free up capital across the board when it's really needed. And that's really just going to kickstart the changing kind of financial system, in my opinion, as we know it.
Okay. I want to unpack that a little bit more, but I think before we do that, we're going to look at the CoinCall trade and unpack that and kind of look at how that's done recently, because I think it's actually done quite well, which is pretty exciting. And then we're going to get into sort of this in-game scenario. When I say in-game, what could happen this year from a liquidity standpoint that could first see a sell-off of some kind and then actually see a melt-up. So we're going to talk about that. But before we do that, thanks to everyone who's here. Really appreciate you being here. Hit the like and subscribe button, thumbs up button. Share this with whomever you think wants a sophisticated market analysis of the crypto markets, looking for something beyond just the random TA analysis. And if you're ready, start dipping your toes into options, following all the great advice or great thinking from JJ. Check out the ref link for CoinCall. They're a great exchange for perpetuals, futures, and spot, where you can trade options. And you can do paper trade, or you can start dipping your toe in with some small trades and get ready for what could be the trade of the year as we start to see that melt up, which we'll talk about in a moment. JJ, take us to the DGen trade that you've been running for a while. Walk us through what it looks like right now.
So last week we talked about that 45,000 call. Obviously that did quite well. Hopefully you took some profits there. Tuesday we were actually saying that the puts queue has remained negative, which means you're paying cheaper for put protection. I still think this is a good time to buy it, and you could hedge more upside exposure here. So what I'm currently looking at is February 29th contracts here on CoinCall. And I think anything below 50K is attractive just because if we do get a correction from here, if that cash and carry trade unwinds, you could see the put premium spike pretty rapidly. So you look at like a 49,000 call or 49,000 put at the end of the month, that's only $750. And you could cover a full Bitcoin's worth of exposure for that. So I think if you're long, these contracts here, 40, 49, 48, 47, all very cheap. They expire in 2 weeks, and that gives you some nice protection. And now you can play the upside with a little bit more aggressively, right? So if you think that, hey, we're going to get this massive squeeze over the course of the next week, you could look at shorter dated call contracts here and really add fuel to the fire for these option sellers, make them sweat a bit more if price continues to move up. 54,000 strike, 56,000 strike, 1,100 for the 54 and 600 for the 5,600. You know, these are gambles for sure, but you're basically betting on this kind of move that we were discussing, similar to what happened in October, where all of a sudden these call sellers feel the pressure and start to cover by buying spot, and that could run us up to potentially like 60K. So I think there's a chance for a squeeze there. And if you're a gambling man, you can go ahead and take something in this range that's low cost and hedge it with the further dated put. I think that's a good idea here. IV is obviously turned up, but I don't think it's reached the top. It looks like it's just going to keep running for the foreseeable future here. So I think it's still a good play to do some strangles here.
All right. There was a question here, Nick D'Souza, why Singapore cannot trade CoinCall? That I cannot answer. I know for U.S. participants and many participants around the world, CoinCall unfortunately is not available in your jurisdiction. That is beyond our control. What I will say is that we do plan on bringing some information to all of you about ways that you can trade within your own jurisdiction, if it's U.S. or APAC, where you don't have access to these tools. That will come with time. Obviously, putting all this information together, it takes a little bit on our end, and we're doing the very best we can to keep up with it. But yeah, I wish it was within our control. If it was, we would definitely let you make it available. Okay, let's move on to the last point, which is the big fat potential trade of 2024. So Ben, we were talking offline earlier about this potential melt up, which first starts out with a meltdown. So I know there's a lot of moving parts, and I know you could explain them in infinite degrees of specificity. But for the audience today, I'm gonna ask you, please, sir, please, what is a simple way of thinking about where the meltdown starts and what the meltdown looks like as it starts to run up?
Yes. There's a lot of different points we could hit on. But I think in a 10,000 foot view, the best way to really look at this is really looking at the financial system in two levels, or potentially going to be two different levels, I should say. And the first level, which is going to be more kind of retail businesses will kind of interact with, and that is really what we see with Tether, right? We see maybe not Tether, but USDC, Circle. That's probably the better example because you have a lot of treasuries on their books that act as collateral. That collateral, you can go ahead and issue essentially a share, just like an ETF. You have all the backing that you're supposed to, and then you issue this share that essentially has this right to all that underlying asset value. This asset value here is all of the treasuries that are on the book. And now you can go ahead with that share. You can go ahead and buy coffee, and you can do normal transactions and pay for something you borrowed with a friend or whatever have you. Go ahead and engage in the economy as normal. Now, this is what JP Morgan has been advertising through what they're doing. Deposit tokens, regulation has already been drafted at the international level to allow for these deposit tokens, which are essentially pseudo stable coins, and underlying collateral being treasuries, sovereign debt. Okay, so that's that first level. And if you allow that to happen, now there's this demand that you must purchase treasuries because you need that backing to go ahead and issue these dollars into the system. So as far as, is there going to be enough demand for treasuries in the market? This is working towards that sort of future, enables all that demand. So a lot of the current regulations need to change a little bit. And that's where all these kind of incoming couple months allows for that transition to take place.
So to summarize that point, the first part is this tokenization of treasuries.
Correct. To summarize that part. And then you have the higher level, which is the settlement of those treasuries between all the different entities. I know a lot of people get scared about a central bank digital currency and how it's going to have all this surveillance capacity associated with it. I'm not a believer that the central bank digital currency is going to take place. I think the Fed Now network will go ahead and facilitate all of these treasury settlements between different banks to go ahead and really make what the books need to be at the end of the day. And that right there is kind of this two-tiered financial system that allows treasuries to be the backbone that creates a lot of demand in that market. And now that allows essentially sovereign debt to roll out endlessly. So if you want to go ahead and purchase a lot of goods and save the economy, well, you got to go ahead and buy more debt.
So what does this, okay, so I think you've laid out, we have this tokenization of treasuries, then you have a massive issuance of debt by the government. So walk us through just, again, at a high level, how that it precipitates a meltdown and then a melt up.
Right. So every sell-off or kind of crisis that exists, and we know they're anticipating testing liquidity once this repo market goes dry. This repo market is where a lot of liquidity sits that has really been being this constant buy pressure in that market. So once it runs to zero, the Fed has stated they want to go ahead and basically test the market. I think we can all know that the market's probably going to fail. It's not going to really step up to the plate and absorb it. Like, I don't think this is a surprise, but the market's going to respond. And then we're going to go ahead and have to act in some capacity, which is always just a tweak of some sort of regulation or rule that exists. And they've been talking about freeing up capital on various balance sheets so that you don't need any dollars to back any treasuries you hold, which means you have a risk-free asset on your book. Okay, what's more risk-free than $1, right? Oh, treasuries now. Okay, so that will be the big change that takes place, frees up liquidity, and that is when we'll be off to the races. That is queuing up for a melt-up condition. When does it take place? I don't think any of us know, but March looks as good as any.
Yep. That's right around the corner, Ben. It's right around the corner.
Beware.
Well, okay, so to summarize some of these stages here, we've got the tokenization of treasuries, which allows them to create this synthetic nature, which allows them to then be able to print a lot of debt and inject it into the system, because then you own the treasuries and you're able to get dollars against it. And then you have them doing a type of QT, right, which is the Fed trying to walk away from the market, allow reverse repo to go down, reduce some of their buying of assets. The market gets shaken up. We're not going to go into all the details today, but we've got commercial real estate as a potential concern because has a lot of exposure to banks in the U.S. We may have other areas, commercial debt. I think we've talked about that before as well. That could show signs of stress. Once that stress hits, then you can expect intervention, and when that intervention hits, that's when that melt up really starts to take place. Ben, did I get that? Did I get that sequence right?
Yep. I wish you were just, in my shoes and could explain it all just like that, because that was a great job. And, just the last 2 points that I'll hit on very quickly is just the timing of kind of these deposit tokens and when they come in. I'm not saying that's a March thing, right? Yeah. You still need some of these regulatory conditions to happen first before those later stages can happen. Okay, you just really have to set the groundwork for that. And the second one is, mortgage-backed securities are in these conversations too. So it doesn't have to just be treasuries. If you do see mortgage-backed securities and real estate in some capacity enter that, like, forget it. That might be a later stage. Oh yeah, we would just go blast past the moon and Mars and
like essentially what you're saying is these banks can hold treasuries and potentially mortgage-backed securities, and you basically get a 2-for-1 in that you own the asset, but in addition to owning the asset on your balance sheet, you also have liquid cash that you can just go plow into the market.
And the yield, right? This becomes an income generating, vehicle. And right now in the credit markets, I don't want to get into it too much because it's literally one of the most boring topics you can hit on. But I listen to them. I do. I find them interesting.
Someone's got to do it.
Someone's got to do it. The debt market, they are going down the risk curve, right? We're seeing packaged up triple B products hitting ETFs now. And I've just heard about a few over the past couple of weeks. And the fact that they're selling these instruments is kind of telling you, like, all right, we're getting a little ahead of ourselves here, that we're chasing yields to this degree. Something needs to kind of have a little bit of a pullback on that.
Okay. With that, I am going to wrap up this show. I know it's a little bit abrupt, but there's so much to unpack here. But for the audience, I want to highlight something for you. We talk about on the show about being early to alpha, and what Ben just highlighted, that sequence, the way that can play out is exactly that. That gives you a model that we can talk about on this show, and we'll continue to revisit, and a way in which you can start to see cracks in the economy, in the markets, that are going to position you to be able to profit from them. And I'm going to tell you right now, that is one of the reasons you need to be watching JJ's videos on options. And if you can't be trading on CoinCall because of geography issues, then you start to explore other areas in which you're going to want to position and express that trade. Because when it does happen, you're going to want to game plan. Because you already had the early alpha, you'll be able to do that. And with that, we're going to wrap up this show. JJ, Ben, Lily, thank you so much for coming on. Really appreciate everything you guys share with us. As we exit the market, Bitcoin sitting at 52,000. Is it going to go to 60K this week? We don't know, but nobody knows, and that's just fine. But joining us next week as we continue to revisit it, and we'll continue to tell you where we think the market is going to go. I'm going to leave you with the same PSA I do every week, which is keep a little bit of dry powder. You know you're going to want to use it. This is Marconi White signing off.